Good day, Junior Tux. This is Mrs. DeMelon speaking, and today we are going to just start looking at credit purchases and allowances. So this is when the business buys on credit from their suppliers. So we are going to look at activity 1, and they say Jameson is the owner of a local sports shop, NAS Sports Supplies, and he has approached you as to whether he should try to negotiate credit terms from his suppliers. And he has always hated to owe people money, so he has opened up accounts. He has not opened accounts previously. So he asks you to explain the advantages of buying on credit and the disadvantages of buying on credit, which safeguards he can put into place. And then Jameson is concerned that his staff might use this opportunity to buy on credit for themselves and to charge the business for it. So he has asked you for advice to put measures into place to reduce this risk. So if we look at the advantages, first of all, buying on credit means that you can buy now and pay later. So you can buy a lot of things, you can buy more things or more expensive things and pay it later. It builds up a credit history, so you need to be able to show that you can pay back debt. So you have to make debt, pay it back, and then so forth and so on. And the better and if you're on time every time, and the longer you do this, the better your credit history or your credit score becomes, and that influences your capacity for loans. Then obviously you can have smaller payments on more expensive items. So for instance, if you buy a car or a house, you pay it off in installments. So instead of paying 500 and whatever thousand rand for a new car, you all at once, you pay it off monthly, and you pay a monthly installment instead of paying the lump sum. Then you can also buy in bulk and get it cheaper. So most of the time, if you buy more or a larger quantity of things, you get some discount, and because you don't have that large capital output, it's a win-win situation. Then the disadvantages, first of all, interest on overdue accounts. So this is when you are not paying your accounts on time and you are then charged interest on account. This also negatively affects your credit score or your credit worthiness. So it's very important to make sure that your accounts are paid on time and that they're not overdue, so that you don't get in arrears and you don't get charged interest. Then, because as I just said, it can also have a negative effect on your reputation, because now you get into the habit of paying late, and now people don't want to give you credit. And as I said, it also affects your credit score, because it then shows that you cannot make debt and repay it, and then you are less credit worthy and your credit score is influenced in a negative way. And then it's obviously more administration work, which is an additional cost, because you have to appoint more people to make sure that everything is recorded properly, that things are getting double checked, and that everything is running smoothly. Then safeguards, and this will be specifically in terms of preventing, as Jamison was scared of, preventing any of his shop or employees buying on credit. So there must be a detailed record must be kept for each and every creditor. You must make payments on time, so to avoid interest on overdue account. You must be able to sell the stock quickly. So you cannot buy the bulk stock if you know it's not stock that's going to sell, because then you're going to get stuck with stock that you have to pay for, but that you haven't sold yet. So that sort of defeats the purposes of buying it on credit, because you want to actually sell all the stock and use that money to pay for the stock. So that's the only way credit sort of works in your advantage. And then the collection of money from your debtors before payment is due to your creditors. So in other words, you have to look at when do my creditors pay me? So when do my debtors pay me? So if I have to pay my creditors in 90 days, I must make sure that my debtors pay me within 60 days, so that I have the cash from the stock that I sold to them to pay my creditors with. Now, internal control will refer specifically to the safeguards within the business and making sure that there's no fraud or stealing happening within your business. So first of all, your goods received must be checked with the invoice. So what you receive at the dock is on the invoice that you ordered. The source document must be very detailed. It must specifically say 3 boxes of snacks, 2 pens, whatever it might be. And that must be properly recorded. So all the documents must be kept on file. These days, everything is sort of electronic and it's automatically saved, but if it's still a paper situation, those paper invoices must be filed with the delivery slip. The correct recording in the journals and ledgers, so you must make sure that your bookkeeper records the documents properly. Then the internal control of the accounts of the creditors ledger, so the bookkeeper will do the journals, but the accountant or the auditor will do the control and make sure that the creditors control account matches the total of the creditors list. And then the most important of all is separation and duty. So at each point or each bubble or circle, there must be separation of duties. So you cannot have the same person who ordered the goods to receive the goods. You can't have the guy who checked the goods, put it in your journal. You can't have the lady who entered the documents in journals also do the internal control or reconciliation. It must all be separate people so that they basically, the one that it goes to is checking the work that they just received. So this is the basic theory behind creditors, and then we are now going to go to the activity 2, and we're going to look at the specific recording of this entire system. So when I receive the documents, how do I record it in the creditors journal, the ledgers, and the creditors list? Thank you for listening. I hope that you are excited about this new chapter and that we can all learn a lot. Goodbye.